Welcome to Smart Stock Watch, your go-to channel for in-depth financial analysis. Today is February 26th, 2026, and we're diving into Warner Bros. Discovery's latest earnings report for the fourth quarter and full year of 2025. Joining us is John, a senior analyst from Smart Stock Watch. John, thanks for being here.
Thank you for having me. Warner Bros. Discovery has had an eventful year, and I'm excited to break down their financial performance and strategic moves with you.
Revenue and profitability overview. Let's start with the top line. Warner Bros. Discovery reported a total revenue of $9.46 billion for the fourth quarter, which is a 6% decrease compared to the same period last year. John, can you elaborate on this?
Absolutely. The decline in revenue is primarily due to decreases in distribution and advertising revenues, which fell by 3% and 7% respectively. However, for the full year, the company managed to generate $37.3 billion in revenue, despite the challenges faced in the linear network segment.
And what about profitability?
For the fourth quarter, Warner Bros. Discovery reported a net loss of $252 million, but for the full year, they achieved a net income of $727 million. This turnaround from a significant loss in the previous year is noteworthy and reflects their efforts in cost management and strategic realignments.
Segment performance and strategic initiatives. John, let's delve into the performance of Warner Bros. Discovery's key segments. How did the streaming, studios, and global linear networks fare this quarter?
The streaming segment saw a 5% increase in revenue to $2.79 billion, driven by subscriber growth and new content offerings. However, the studios segment experienced a 13% decline in revenue, largely due to fewer theatrical releases and lower content sales. The global linear network segment also faced a 12% revenue drop, impacted by declining pay TV subscribers and advertising revenue.
And what about their strategic initiatives?
Warner Bros. Discovery is focusing on expanding their streaming services, particularly HBO Max, and enhancing their content library. They're also working on optimizing their cost structure across segments to improve profitability, as reflected in their adjusted EBITDA of $2.22 billion for the quarter.
EPS forecast and analyst expectations. Analysts had forecasted an EPS of 2 cents for Warner Bros. Discovery, but the actual EPS came in at -10 cents. What does this discrepancy tell us, John?
This indicates that while the company has made strides in certain areas, there are still challenges impacting their bottom line. The negative EPS reflects ongoing restructuring costs and investments in content and technology. However, their adjusted EBITDA for the full year was $8.74 billion, showing strong operational performance despite the EPS miss.
How are analysts reacting to these results?
Analysts are likely to focus on the company's strategic direction and cost management efforts. While the EPS miss is a concern, the overall sentiment may remain cautiously optimistic given the company's long-term growth potential in streaming and content production.
Market reaction and future outlook. John, how has the market reacted to Warner Bros. Discovery's earnings report, and what can we expect moving forward?
The market reaction has been mixed. Investors are weighing the company's strong cash flow generation with $1.38 billion in free cash flow for the quarter against the challenges in their traditional media segments. With $4.6 billion in cash on hand and a net leverage of 3.3x, the company is in a solid position to manage its debt, having repaid $1 billion of the bridge loan facility.
What should investors keep an eye on?
Investors should watch for further developments in Warner Bros. Discovery's streaming strategy and any new content partnerships. Additionally, how they manage their debt and leverage their cash reserves will be crucial in maintaining financial stability and supporting future growth.